So, Michael, we've been recently asked a lot of questions about finance, investing, and the world of stock markets by friends and family. So we've decided to do a show, a little podcast about finance, a tutorial for our friends. The objective today is to simply demystify finance and stock markets.
And also so they stop talking to us about it.
Yes. And we want to keep it simple, anchored in examples, and practical. We don't want to use esoteric jargon that people use to show other people that they belong to an inaccessible private club.
We're not showing off.
We're not showing off. Simple, practical, easy. We're going to start with a very powerful concept. You've been waiting to talk about this for a long time. We call it compounding. En français, intérêt composé. It's simple, yet extremely powerful. Go for it.
Intérêt composé. Well, the idea is you want your money to grow. The best way to get it to grow is you start as early as possible, and every year you make money, and that money that you make makes money, almost like a seed. You plant something, and then it gets more seeds, and the idea is just to make it grow. And how you make it grow is by having a rate of interest that you're going to earn on it, and that you keep the money in, and every year it goes up. And on average, let's say if you can earn, 7%, it will double every 10 years.
Yes.
Okay, so then after 10 years it doubles. After 20 years it goes up times 4. After 30 years it goes up times 8. After 40 years it goes up by 16. And the idea is if you can make your money grow, then this money that you have over the course of your life will grow to larger and larger sum. Some of that would require you perhaps to sacrifice in the beginning so that you don't purchase something early on that, let's say, €1,000 purse that you would buy when you're 20 or 25. If you just hold off on that 1,000, will become 4,000 in 20 years.
I'll say it in a different way. You're young, you have a desire to be rich when you're 40 years old. Maybe you don't, but if you do, listen to us. You start compounding. So you invest a little amount every year. You make it grow. You choose a very solid index, a solid market, possibly the S&P or the NASDAQ, something that is not too exotic or dangerous. Usually, stock markets go up 8% per annum, 6% in capital appreciation, and 2% in dividend. When you start young, the beautiful thing is that you absorb losses because you have 20, 30, 40 years to make money. So if it goes down for a couple of years, you don't really care because you are in this for the long term. So what we're saying is that everything that you're not spending, you can invest, and you take your time, and it grows very fast. As Michael say, at 8% per annum, in 9 years, you've doubled, and in 5 years, you've made your money 4 times. So we think it's
Yeah, and the idea is that you have to get away from this notion that you want to make money very quickly, because most people, that's what they want. They want to go into something, they want it to go up times 10 in a couple of years, and it's unrealistic and it's counterproductive, because the idea is to have the money grow by a small amount over a very long period of time, and you can make quite a lot of money doing it that way.
And the rule is to try not to interrupt it, because after 15, 18, 20 years, that's when you start crushing it, because the money is big and the interest that you earn on the money becomes gigantic.
Yeah.
So it's something that you don't want to interrupt. And that's how people get rich. I mean, the anecdote is that Warren Buffett became very rich old because he was starting to compound big time. So you keep the money. It's money you don't need. You don't want to have to sell after 2 years because you want to buy an apartment or a stupid purse. You keep it and you let it monetize.
A purse or a watch.
Or a watch.
Or a watch.
Or a watch, yes. So that's compounding. We want to say also a quick word about inflation because it's important when you invest. So what's inflation? The definition is very intuitive. It's a substantial increase in the price of goods and wages. So in 2025, you have a $100 bill. You put it under your bed. With this $100 bill, you could buy 50 bananas. 20 years later, you look at your $100 bill and it can only buy 15 banana or 10. So inflation is dangerous because obviously it's the erosion of
it eats away.
It eats away. It's the erosion of your purchasing power. So when you hold cash and you do nothing with it, and that's why in the first section we are advising to start compounding investing. When you hold cash and you do nothing with it, inflation eats it.
Yeah.
So you want to avoid that.
And the idea actually is that a lot of people we know are so afraid of putting their money to work that they do have their money just sitting there. It's not growing. It's not. That's why we're doing this. We want our friends' money to grow.
Correct. So the best way, you probably have guessed it already, the best way to combat inflation is to invest. Usually, stocks do well when there is inflation. Not only they do well, but they beat inflation. Because if you tell me you've earned 4%, but inflation was 6%, I will tell you as a financier that you've in fact lost 2%. Your real return, not your nominal return, is -2, plus taxes. So you always want to compare your return to the inflation rate. And the best way to beat that is to buy stocks, again, on money that you don't need, or possibly to buy gold or Bitcoin. We will talk about that
or bonds,
or in a podcast. But yes, what you want to avoid when there is inflation is holding cash and also be a lender. Why? Because if you lend $100 to someone, you get your coupon every year, and 15 years later, it gives you back $100, but now $100 is worth 5 bananas and not 15 bananas, then it's not a good investment. So if you believe, but it's tough to predict these things, but if you believe there's going to be inflation, then you probably don't want to learn. So the bond can be dangerous, but definitely in order to exceed inflation, equities, stocks, it's the same. Possibly gold, dangerous, but possibly gold, not these days, but dangerous, and possibly Bitcoin.
Yeah. And time is your friend. That's the thing that you have to remember. The longer you can do this for, the better odds are that you will end up having a favorable outcome.
Yeah. So now we're going to say a quick word about stocks and bonds, the two major investments. So quickly, because you guys know that a stock is a stake in a company. If you buy 10 shares of Google, you own a stake in Google. It's a micro share, obviously, but it's a stake in Google. With these stakes, you have the right to collect earnings. We call it dividend. So the company is going to have a profit and you're going to get a dividend. Dividends are very important. Michael will talk about it later because dividends are sometimes neglected. And when you hold some Google shares, you hold voting rights. In theory, because usually your stake is too small if you are an investor like us, you hold a voting right and you could vote on decision and go to like board meetings and all that.
I've never done it. You?
Never. And of course, when you hold a stock, you have the right to sell it and hopefully capture a capital appreciation. My advice on stock is the following. Try to look at sectors that you understand. If you work in fashion, look at fashion stocks. It's interesting because you may have an advantage that the crowd, that the rest of the people don't have. You understand the business model of Kering. You know that the new DA is a big deal. The new CEO is a cost killer, is good. The market is neglecting it. You think they shouldn't neglect it because the guy is going to come and he's going to restructure and all that. That's how people sometimes invest. They invest in something that they understand. I would not recommend to invest in business model that you don't really understand, because if you cannot really explain it, then it's a bit tricky.
You shouldn't also invest too much in the thing that is your industry that you work in, because you already are invested in the success of that industry.
That is such a good point.
That
Yes,
is a good
yes,
point.
it's a good point. Yes, because you would be overexposed to a specific sector, and you don't want that, because you want to diversify, and we'll talk about it in a few
This
minutes.
is the point where we make it very clear. We're not here to give you specific recommendations. It's just more to sort of how do you think about
Yes.
investing your money. You start with the idea that you want it to grow over a long period of time, that you're going to leave the money in there, and then you have to figure out where you're going to put it. That's up to you. It's about what your preferences are. But there are some things that are going to be, you don't want to spend too much time also looking at the markets. No?
No, not too much time. No, not more than an hour per day. So I think it's maybe not to invest. You're right, but look at sectors that you understand. It's interesting because you may have a little edge. And also, I mean, that's what I find personally fascinating about stock market, is that sometimes it's as simple as looking at Apple in 2007 when they released the iPhone and say, this is going to revolutionize the world. I should hold the stock. Or if you were very smart in 2021 and you say to yourself, AI is going to change the world, what are the main AI companies? And if miraculously you looked at NVIDIA, you absolutely killed it.
Yeah.
So that's a way to approach stock markets. Also, of course, you have to look at valuation, because, stocks have prices. You have to look at the quality of management. There's plenty of metrics, but looking at it this way is often, I found, entertaining.
Yeah.
Would you like to say a quick word about bonds?
Well, the bonds are different than stocks in that it can be either a country or a corporation. They will basically, you will lend them money and they will promise you a rate of return, and you will earn this interest, and it's called fixed income. Fixed income and bonds are the same thing, and it's just that this is something you can rely on. They will promise you, let's say you have a bond that pays 6%. Every 6 months, depends on how often you get payments, but they will pay you an annualized rate of 6%. So if you invest $10,000 in a bond that pays 6%, then you will get every year 600 euros if it's denominated in euros, and this is something that you can count on. Now, very often people who are older, they prefer fixed income because they have their expenses and they want everything to be fixed. This is why the idea of starting very early, and in fact, why you delay a lot of the this sort of gratification in buying things, is so that later in life you have more money to spend when you're not earning money. So a bond is just a promise on the part of a corporation or a government to give you a certain rate of return over the maturity of that bond. It could be a 10-year bond, it could be a 30-year bond. Sometimes there's a T-bill is a 30. It could be a 90-day T-bill, and it's just what you're going to earn over 90 days.
Yeah. So those are really the two main asset classes. I mean, of course, there is commodities, gold, oil, cryptos, real estate, but today we're focusing mostly on stocks and bonds. We want to say a quick word about risk management. It's important. I think there are two rules, really two important rules I would like people to recall. A, there is no free lunch. It's not from me, it's a famous quote. It means that if someone promises a return of 15% with no risk, the finance world is just not constructing this way. It doesn't exist, so no. It's usually high risk, high reward, or low risk, low reward, or medium risk, medium reward. But there is no 15% per annum return with no risk. It doesn't exist.
And it's happened to a lot of people. If that is what is promised to you, in all likelihood, you are it's a scam, Ponzi scheme, or it's not going to work out generally.
Yeah, so no free lunch. The risk-free return is probably 3 to 4% these days, more or less. You look at the US bonds over 10 years, 4%-ish. If someone says 7% no risk, it doesn't exist. 7% is equities. Equities are dangerous. They can go down 25% like they did in 2022. They can go down 40% in 2008. They can go down 75% in 2000 on NASDAQ names. So if you have to sell, you would have to sell at the low. So they are inherently risky. So beware of that. The second rule of risk management, to me, for people who are not professional investors, is sleep at night. Sleep at night.
Sleep at night.
A good night of sleep, 8 to 9 hours. Not wondering if the market is going to crumble on your savings that you earned at the factory last night. So, just invest the money you don't need. It's important that you don't need, that you're not going to need to sell tomorrow, because tomorrow the market can crash 15%. In April of this year, right, the market crumbled. It was losing 5% per day. It was panic. If you had to sell, it's terrible. So be long-term, be cautious, sleep at night, and just invest the money you don't need, compounding the way we describe it.
And understand that it's for the long term, so that if there are these what they call drawdown, or if there are sharp reductions, you will understand that you're still going to leave the money in there to work over a period of time, and then you've just hit a bad slice of time, which is going to happen.
Yeah. And also, in terms of allocation of assets, what people say is that now I think you have fully understood that if you're young, you want to be invested in stocks. The rule of thumb is if you're 20, you should invest 100 minus your age in stocks. So if you're 20, 80% of your savings, that makes you sleep at night, should be invested in stocks, and probably 20% in bonds. That's a good allocation. The more you age, the more you have less time to compound. So when you're 50, it's a different story. And when you're retiring, you're probably more in bond. It's safer.
Yeah, you don't want to be worried.
You don't want to
be worried. And
it's
harder to sleep.
So, 80-20. I would argue that you could also do 70 or 80 stocks, 10 to 20 bonds, and 10% in cash if there is a huge opportunity. I think it's interesting. If, like in April, the market crumbles, you could say, okay, I'm buying the stock market on the cheap, so I'm going to buy it. If one day Google goes down for no reason, you may want to buy it. So it's always good to keep a little bit of cash, I believe, in order to have opportunities that open up once or twice a year. So diversification is important. If you're young, you start compounding and you invest probably most of your money in stock equities. I think that would be the right move, and you probably choose something very solid because it's probably an index, the S&P, the NASDAQ, the CAC 40 in France. Who knows? But you're not going to start compounding on Argentinian peso because it's volatile. It's risky. It could go up 100%. Could go down. It's difficult. So probably you wanna if you compound over the long term, you want to do it on something quite safe.
Yeah.
Now we want to talk about something that you want to talk about. Émotion et psychologie. So
this is the toughest part.
Yeah, you've been trading for a long time, so you know these things. You've been through that. So
well, you also see it in other people, and the fact is that there are a number of different emotions at work when you invest. In markets, they say that greed and fear are the two things that move markets the most. But I would also add jealousy, because people see other people making money, and they start to feel like they're missing out on things. And you just have to recognize what is happening. And this is why we're sort of doing this podcast, is so that people can put together a framework for where they understand they're going to be diversified. They're going to keep in the market for a long period of time, and that they should know that there are going to be periods where you are worried, but that is part of the cycles of markets. And that I had a friend recently this year over when there was the tariff meltdown in stocks. The market went down, was it like 20%, and he got out of everything. Now, looking back, this is the type of thing that we want you to avoid doing, because then the market not only made back that 20%, but went up another 20%, and he missed out on all of that. And he's somebody who's in his 40s. So you have to realize that you will be tempted to sell when you see things go down, but that you have to have an awareness of what these emotions are. Also with the greed, I think it's a big problem. Which we may be experiencing now in markets today, where people see other people making money and they want to make money, and they think it's not easy to make money. There are periods of time where it can be easier, but since you're going to be doing this for an extended period of time, you should know that there are a lot of emotions involved. Yeah.
A lot of emotion. I think you want to avoid, it's kind of what you said, but you want to avoid FOMO, fear of missing out feelings. You want to be patient. You want your money to grow. You want to avoid losing money. So, in a perfect world,
this is actually with cutting your losses.
Yeah,
it's an emotion that you have to then absorb the fact that you have done something you shouldn't have done, or that it was a bad idea. And but this does run a little counter to what we're saying when you leave your money in. But the fact of the matter is that if you have an idea about something, let's just say you talked earlier about somebody in the fashion industry who maybe thinks that Kering would be a good investment, and they put the money in, and whatever their premise was for putting the money in ends up changing, and the market goes down 20%. It might be a good idea for them to get out of that position.
Yeah. They always say that the good traders, the gifted traders, are the traders who cut their loss quickly and who let their profit ride. But that's counterintuitive, because usually it's known that people tend to sell quickly their profit because they want to make a quick buck. And when they start losing, they're like, it's going to rebound, forget it. But usually, if you're a good trader, and I'm certainly not saying I am, you cut your losses quickly. You don't FOMO. You don't buy things with the crowd because it's trendy. And when you write on a stock and the stock goes up, and your investment thesis hasn't changed, then you don't sell.
Right.
You let it ride.
I think maybe we should talk a little bit about this sort of contradiction, because it ends up being a big thing between cutting your losses and keeping your money in the market. And I think with the cutting your losses, that's maybe more for very specific stocks as opposed to having your money in the market in a general way, because you can buy a total world stock index or a fund where there are hundreds and hundreds of companies in that. But if you have, and this is where the diversification comes in, if you have all of your money in one stock, and you have made a bet which we're actually dissuading you from doing, but that's where you want to cut your losses more often than not, is when you have had an idea and you realize that idea didn't play out the way you thought it would, or maybe it will much, much later, but there's nothing, it's very difficult to absorb when you're losing and keep losing and keep losing. It's something that you have to, over the course of an investment career or lifespan, when what we're advising is for people 20 years old to have their money in the market for 60 years. You're going to have moments where it's quite difficult, and you're going to suffer because you have lost money, and then you have to deal with those feelings.
Yeah, I agree. Maybe there is a slight contradiction. We're just saying that on your core investment, you should be long-term, patient. You buy, you hold on the big index. And I was more talking about if you start doing some tiny, non-risky investment in things that you understand, if you want to really go into the specific of stock markets, and more short term, more like you're expecting a catalyst, there is a nice story, then you should be cautious on the potential loss. Yes.
And then we wanted to let people know how do they, what do they do? Let's say they have the money. They have, I don't know, 10,000 euros, 5,000 euros. What is it? How do they go about beginning the process?
Okay, so in France and in America. So in France, I can explain. There is something called a PEA, Plan Épargne Action. You just open one with the main French, brokerage account or brokerage companies, Fortuneo, Bourse Direct, guys like this. You open a PEA, and the PEA is interesting because it's tax efficient. After a few years, you pay very few taxes. The only problem of this PEA is that you need to invest in stocks in Europe. It's not a big deal, but sometimes the action is really in America. It's Google, it's Nvidia, it's Microsoft, etc., etc. Sometimes you lack exciting investment vehicles in Europe, but of course there are great companies. So you open a PEA, Plan d'Épargne Action. You go to your bank, or you go to a little brokerage firm or a big brokerage firm, and then you can open and start adding every month on like a big index. We advise you aggressively to look at cost, fees, because as Michael explained in the compounding, the difference between compounding at 5.2% per annum for 25 years and 5.4% will end up being huge when you're 45 or 50. So look at costs, fees, because you don't want to spend an unnecessary amount of money in fees that you could otherwise avoid.
Yeah. And a lot of the industry is also set up so that they can extract fees from you, which you want to avoid.
Yes. And how do you go about it in America?
Well, then you do the same thing. You go to a Schwab or Fidelity, and you just wire money or bring a check and open up an account. And then you have the money in a stock account, and you just hit buy. Now, this is where we should also say that when you're buying, we should get into maybe the specifics. When you buy, let's say you buy a fund, what would be like a SPY, let's say. So SPY is just the S&P. It's an exchange traded fund, and you would go into your Schwab or if you want to do it in Europe, I don't know, what is the ETF for like a French or European market?
I don't know, but let's say the CAC 40. Yeah.
CAC 40. And you would say, well, I don't know, you would figure out how much one share cost, and then you would use your money to buy however many shares you can buy, and you would look at the price. It'll say the bid and the ask. That's how much somebody's willing to pay for it, how much someone is willing to sell for it. And then how would you suggest that they go about doing it so that they don't get taken by sort of a market order?
I don't want to get
too technical,
but if you buy something liquid, and we obviously recommend that you buy something liquid, like
highly recommend. What do you mean by liquid? So they understand.
By liquid, I mean that you can buy very easily. There is many shares available, and you can sell quickly, because one of the risks of buying stocks is that you may be right, the stock goes up, but then you want to sell, and there are no more buyers. So you bought it.
That would be illiquid.
Illiquid, yes.
Illiquid.
You bought it at 10, the stock, it goes to 14. You're very happy, you want to sell because it's a quick 40%, but suddenly you start selling and it goes down because there is no buyers, right? So you want to avoid what we call the liquidity risk when you invest. Sometimes you have no choice, but that's why also we recommend to invest in like indices and large companies, because you will never ever
have a problem
with that. So since we recommend to buy liquid stocks, just buy at we call market, and you will have a price that will be within the range of expectations. That will be good.
All right.
All right. We good?
I mean, I think that we've given him a good start.
Yes. Thank you, Michael.
No, thank you, Pierre.